Director of Prestige Wealth Management Group, and Paul Esposito, who serves as our Senior Portfolio Manager. This conference call will be in a listen-only mode and should last approximately 30 minutes. No participation is required, and there is nothing you need to do except sit back and relax. We will take care of the rest. We can't take any live questions during this call, but we do welcome your comments and suggestions. So at the conclusion of the conference call, please feel free to send us an email with your comments and questions to pwm@prestigewmg.com. And with that, here's Roy.
Welcome, everybody, and happy summer. So another interesting quarter has passed, and, just to recap, the equity markets were up for the quarter. May started deteriorating, and then the Fed stepped in, which we'll discuss in a second. So a nice June. And then some of the economic numbers, again, continue to deteriorate, which we'll discuss. But overall, and also in the second quarter, you had interest rates drop in the quarter. So why don't we get into a discussion of, we hear a lot from clients, John, about the trade wars and the impact of that. What do we see happening in terms of with China and with the trade deals going forward?
Well, I think starting with May, I think the markets reacted very positively early in May based on what was being reported in the news as an imminent trade deal. We had a pretty fair dip starting in mid-May when it looked like trade negotiations were falling apart and that China had walked away from the table. Since then, the president has been speaking with China in June, and things look like they're back on track for a potential deal. But it's still very fluid as far as the timing of which and what it may look like.
Paul, you and I talked about GDP was a big surprise last quarter, how it continued to sustain in spite of some, slowing economic indicators.
Right, and I think that is, overall the dichotomy of the markets, right? So the markets trended higher last quarter. That in the wake of a lot of mixed news. One being GDP growth, right? There was a lot of fear that trade war concerns would bleed into lower GDP for Q1. To our surprise, it actually, on an annualized basis, was about 3%. The question lies in this, Q2, which those estimates will come out July 26th. We're expecting a softer print of about 1.8%. Again, that resonates also with the earnings picture for U.S. corporate earnings, where we did contract slightly by about 0.3%, although the estimates were far lower, at the start of earnings season, and companies managed to surprise. I'm of the belief that we're probably going to see a similar pattern. We're expecting, a 3% decline quarter over quarter for the second quarter S&P 500 earnings, but revisions on average have been 3.7% upwards. So, if all goes well with this earnings season, we could see, a slight positive read. But, when we look at overall economic indicators, I think it's important to, for us to realize, given that we're this late in the economic cycle, it's common for us to see some weakness and some strength. We were talking yesterday, Roy, and we acknowledged that retail sales for June were stronger, right? They were actually double what the expected survey was. But then again, today we take a look at housing starts and building permits retrenched to to levels where there's a bit of a mixed message.
Yeah, and a lot of the economic indicators, when you talk about tariffs, they do have, impact on some of our, in terms of purchases. I bought a freezer last month, and, it was a couple $100 more than it was because of tariffs. So, I'm hearing from clients who are making purchases of appliances that they're $100 to $200 or more because of the tariffs and the impact. And we also saw, which we talked about in the Federal Reserve. John and I were talking yesterday. The Federal Reserve. If you think about it, in December, the market has its worst December since 1931. Most of us were not around in 1931, but the worst December since then, because the Federal Reserve was going to hike interest rates 2 to 3 times. Then they come out in January and they're not going to hike rates. And John and I were talking about this yesterday, and Paul. And then now they came out, they're going to lower rates. So the Federal Reserve has really, John, right, been a little bit of fuel here.
Yeah, I think the Federal Reserve is from last year at this time has completely flipped. Right, we went from restrictive monetary policy in the summer of last year through the end of December. January we went to neutral, completely neutral policy. And now the Federal Reserve is indicating, hasn't actually occurred quite yet, but is indicated through their language, that they're ready now to shift to what would be considered an easy monetary policy, which would certainly support the economy and would support asset prices.
Yep. So, but there's a lot of moving parts now. I read an article earlier this morning, in terms of within the global economy. When we look at the global economy, Germany has always been at the forefront of, leading manufacturing, high-quality nation. And, well, we were looking yesterday, their second quarter manufacturing index is one of the worst in the world.
Right. So that has been a trend that we've noticed, I think, really prior to the trade war, trade talks ensuing. We did notice, a slowdown in global manufacturing. The service-based indicator for that also looks to be tracking manufacturing as it normally does. I think that that decline, though, has been exacerbated by the China trade spat that we've had, because it's even talk of future tariffs can be very disruptive to future supply chain management, which has been one of the major concerns of most multinational corporations. So as a result, you are seeing weakness. So to see the Fed respond, you're seeing all-time highs in the equity market. You're seeing a good run of good data. We're also seeing some negative data, but I think this is the Fed's most prominent concern, and it's the concern of other central banks. This is why the European Central Bank and the Bank of Japan are entertaining, or really were the first before Mr. Powell was induced into this tentative rate cut at the end of this month. They're entertaining a loose monetary policy as well, and it's really due to both of those figures, both manufacturing and service-based numbers going down. Now, is this transitory? That's the question, right? We've seen periods like this before, and who knows? I mean, if the Fed and other central banks are cognizant of it and are cutting to help, sustain asset prices, this could cause a growth acceleration.
Right, and again, that's a hard thing about predicting what's going to happen in the future. Pretty much from what I've seen, most people are predicting a recession, but it's when it's going to happen, and if it's going to happen. Again, with we get a trade deal, we have Fed cut. Who knows what's going to happen? It's very difficult to predict. That's why, as we always talk with our clients, is important, and I'll talk about the end. Your portfolio is very important, how you're allocated. When we look at the U.S., John, from a valuation standpoint, it's, when we look at this slide, could be a little overvalued, could be a little bit undervalued. Depends on what happens if growth accelerates and earnings accelerate if we get a trade deal.
Sure, absolutely. I mean, if we got a trade deal and we saw a spike in earnings, certainly we would see where we stand today as maybe being somewhat cheap. But under current conditions, I'd say it's probably right around the averages. We're pretty close to fairly valued. I wouldn't say the markets are cheap. I wouldn't say they're expensive at this point.
Yeah, and again, that's pretty much consensus. Some individuals out there say maybe it's overvalued, if earnings come in. But again, a lot depends upon the trade deal and the Fed, and those are unknowns right now. Paul, you brought up unemployment. Unemployment, when we look at what really helped us come out of the Great Recession was 10,000 people a day turning, who are 60 or 55 to 70. The boomers are 10,000 people a day turn 55 to 70. So when large companies have layoffs, a lot of times it doesn't even hit the numbers because of a lot of them are just retiring and then maybe consulting. So it's pretty interesting in the environment we're in right now. When Paul, you were talking a little bit about earnings revisions and operating earnings before. Why don't you talk a little more about revisions and earnings?
So I think that is really the next hurdle for the markets to overcome here. We're in the heart of Q2 earnings season. So far, about 50 of the S&P 500 companies have announced. One of the trends that we saw in the prior quarter was net earnings revisions. Basically, the number of companies that are increasing their earnings forecast versus decreasing their earnings forecast for the next quarter. As of the end of June, that looks like that it was bottoming, which usually portends to the fact that there's going to be revisions or a net revision of aggregate earnings to the upside, which does provide a little bit of promise to the markets, but that downward trend was very concerning. From about the start of the year, we started to see a number of earnings revisions to the downside from some major S&P constituents, which is kind of surprising. Normally, the market sort of follows that, which is why I think the dichotomy of stocks at all-time highs and yet we're seeing negative guidance on earnings.
Let's talk about that a second. Large cap stocks.
Sure.
Small and mid caps are 10% or more from their highs, which is unusual in this type of environment. When markets normally hit new highs, you have small and mid leading the way.
That's true. That's true. Last September, if you look at the Russell 2000 index, that was the peak in the small cap valuations, and you've had the S&P 500 come out and make all-time highs as of late, yet you're still about 10% underwater from the high water mark with those smaller corporations.
This could be indicative too of late cycle behavior.
Correct. I would agree with that, John.
Yeah, and late cycle behavior, when we're late cycle, again, that's the biggest issue. When does the cycle end?
Well, I think I think it also be a good time to take a moment and mention some of the changes that we made in May in relation to where we think the cycle is and why we did such.
No, absolutely. Given that we do believe that we're in the latter innings of the ball game, so to speak, we reduced our equity exposure across portfolios back to equal weight.
Meaning if it was 60-40, a lot of those portfolios are 64-65%. We went back to 60-40.
That's correct. We went back to the strategic asset allocation first and foremost, because that equity allocation being overweight served us very well in the first 5 months of the year. Secondly, we substantially reduced our small and mid-cap exposure across all portfolios, just because large cap companies tend to be a little bit more resilient should we encounter a slowdown. And then finally, we also, to enhance a little bit more of a defensive stance, while still maintaining upside exposure in our stock portfolio, we did add minimum volatility, which is a factor-based asset class, to the allocation, which is in more consumer staple-oriented companies, some utilities, more non-correlated. So, in days which have been few and far between this year, maybe with the exception of May, where we see large drawdowns in the market, that's acting as a buffer to the downside. So,
but to the point I was making earlier, we overweighted large cap stocks tactically in May, which has, at least in the short run, benefited our clients.
Absolutely, and I think given the fact that the Fed now is embarking on lower interest rate policy, especially that the minimum volatility addition to the portfolio should fare well, given the fact that we have some of those tend to be a little bit more interest rate sensitive.
Let's speaking of interest rate sensitivity, let's look at interest rates. Again, the forecast, and again, this is a forecast, just as in December is a forecast or increase rates. Paul, now there's a forecast that they'll decrease rates a couple times.
That's right. If we look at the projection of forward Fed funds rate, we're looking at this point, two are definitely in the cards based upon interest rate probabilities right now. We're looking at 100% probability to get a quarter percent cut at the end of this month, possibly another one in November or December. But it was initially expected that we would get between 0.5% to 0.75% in cuts by the end of this year. If we go out into next year, it actually gets a little bit deeper, something along the lines of about 1%. And again, it seems a little counterintuitive, right? Unemployment is 3.6%, well below the long-run target for the Fed. Real GDP is humming along, north of 2%, again, above the long-run target. Where the Fed is most concerned is the deflationary trap. That's the concern of all central banks, right? They've thrown a ton of liquidity at the great financial crisis, and to try to stoke, more growth, more inflation, and they're not seeing it. Obviously, we could debate all we want about the true readings of inflation, but the number that they're following, that PCE inflation number, has been running, between 1.5 to 1.7%. That number is probably a little underdone, I would say. We're probably running, maybe 0.2%, 0.3% below that number. So, is a cut warranted? In my opinion, probably not, but the market at this point has baked it in, and I think the Fed is pretty much bound to the market's expectations at this point, which is why I think we'll see a cut.
Yeah, one thing to understand with this chart, if I look at the past 4 years, these charts starting beginning of the year, they've been wrong every year in terms of what was projected with the Fed. Every year they've been wrong. So again, depending upon if we get a trade deal, they may only cut twice this year and not cut next year. If we'll have to see how. There's too many moving parts right now that we're looking at as to what's going to happen to really have a definitive outlook for next year regarding interest rates. It depends how all the pieces come together regarding things that we've been discussing, such as a trade deal and earnings. When we look at the yield curve, most people, a lot of people in the industry look at meaning advisors and economists look at this, and we talk about this internally, the 3-month to the 10-year, or, on CNBC, it's normally a 2-year, 10-year in terms of the yield curve. So with the Fed cutting rates, John, that should help alleviate pressure on the yield curve as we go forward, correct?
Yeah, I think the yield curve inversion is simply forecasting the coming rate cuts on the sort of long end of the curve, is just reflecting that. And I think it's indicative of why our portfolio is situated the way it is.
Yeah, again, on the bond side, I had, Paul set up the pleasure of sitting next to the professor, Jeremy Siegel from Wharton, and, I had a discussion with him regarding, fixed income and bonds. For those of you who were around in 2002, 2003, and 2007, once rating agencies, we moved our bond portfolio to be high quality and short term because once the rating agencies miss and it comes out that they missed and maybe should have downgraded one or two companies, they really go out there and start downgrading many companies.
They do it in aggregate, and we've talked about this in previous calls about how rating agencies are being maybe a little too liberal about some of the leverage ratios they're using to distinguish investment grade versus junk or below investment grade issues. Again, based upon our theme that we're very late in this economic cycle, the goal is to be very high quality, which our portfolio is. Now, this curve represents the Treasury yield curve. Obviously, our portfolio is constructed of higher yielding, but still retaining higher quality corporate agency mortgage-backed securities as well as Treasury securities.
Yeah, and I just want to point out it's important. We believe, and again, if you look at the last quarter of the year, it just showed what can happen, John, quickly to junk bonds.
Absolutely.
And low-rated bonds. In the quarter, they had significant losses.
Right. So I think one of the other traps too, Roy, is most people anticipate that, well, if the Fed's going to lower rates, why don't I go and step out on the back end of the curve and go buy 10-year paper, 15-year paper because I'm locking in a 2% gain. Keep in mind the Fed's goal of lowering rates at the short end is to spur more inflation. So right now, because short-term rates are so high, the curve, to John's point, has inverted, right? Meaning 3-month yields are higher than 10-year yields because the outlook for inflation is muted. Should they lower rates, which it's anticipated, that could stoke additional inflation. And it's not uncommon to see intermediate and longer-term bond yields actually start to increase. So again, the risk-reward trade-off, that's been our stance, from the get-go, is that, shorter-term yields are yielding higher than what intermediate and longer-term yields are, is a good proposition.
Now let's talk about China, trade and Brexit, John. In terms of let's hit China trade first.
Right. Yeah. I think that this is certainly front of mind from an investment standpoint, and you can see right away when you look at the charts that not only is it affected, or the tariff war has affected global trade, but it's really affected China trade in particular, significantly. So if we did get some type of a trade deal and we saw an alleviation of some of this, it could certainly extend the runway for the cycle.
Yeah, meaning the economic expansion continue to hit a new record length.
Yeah.
Even slow and steady. That's one thing that the economic expansion that we've had hasn't been the greatest in terms of percentage of increase in GDP. It's just been very, very slow and steady.
Yeah, and I think they go together, right? Because we've had such little growth. The growth that we've had over the course of the cycle is probably the slowest growth of any cycle. So it would make perfect sense that something that's growing so slowly would last so long. How long is always going to be the trick.
Yeah. Again, my concern with which we talked about, and this is a lot of economists are concerned is as we get further and closer to the election that China's just going to wait and see if President Trump wins the next election or we have somebody new that they can negotiate with. So hopefully, they hurt Paul, we were talking about this yesterday. They hurt way more than we do by not having a trade deal.
I think that's fairly evident by the chart to the right. I mean, if you look at China's export versus, in comparison to all of its trading partners, just within the start of this year, I mean, it started prior to that, and I think some of that was attributed to their own slowdown in their economy, but it's been exacerbated by tariffs. And the additional onset of tariffs, were actually taken off the table at the G20 summit. I don't know if those will be used as an additional policy tool, but that could certainly make matters far worse for China. And in particular, I know we talked about this before with U.S. company concerns, but why is China, given the fact that they really don't export, or should I say, we really don't export that many goods to them, why is that so critical to the U.S. economy? Well, it has to do with the supply chain. If you look at industries like technology, anything from rare earth metals to electronics, the supply chain is critical for China. So I think President Xi understands that dynamic. And to your point earlier about waiting it out on the election, we'll see. But I think at this stage, in the short run, China has a little bit more to lose. In the long run, yes, they could certainly play that waiting game.
And we're hopeful that a trade deal does happen, hopefully by early fall. I remember when we were saying we hope by
Early spring.
Early spring.
And a year, it's much like Brexit, right?
And now we're saying early
saga.
Early fall. And speaking of Brexit, we're going to talk about that now. Not really a lot has happened with Brexit, except that you see when you see the deadline of March 29th, that's continued.
Yeah,
we were talking yesterday about it.
Right. So originally it was April 1st of this year for the UK to get a deal with the European Union. At this point, it's been pushed back to the 31st, October 31st deadline. I think the uncertainty surrounding this is really going to affect more so European economies, but it certainly could resonate, to the rest of the world. I mean, there's always a contagion issue, right? China's having growth problems that resonates through the periphery. Same thing with the UK. The crux of the matter is, do they get an orderly Brexit? Meaning, do they get trade agreements put in place? Do they get various regulations that they had as a member of the EU or a former member of the EU outlined with the European Union? If they don't, the risks to that are they now have to abide by the WTO policies, which could cause an onset of tariffs. And we looked at the breakdown of their economy, that could be very restrictive to them, and it could be very restrictive to a lot of their trading partners.
And also hurts, if we really look at it, the currency has just been devastated by the whole situation.
Right, because that could be a path to more inflation, right? So if price of goods that they're importing for inputs goes up, that could cause them to certainly weaken.
Yeah. And again, they've been a great economy and a large consuming economy. So again, it does impact, as you were saying, it resonates throughout the whole world. England as an economy may be small compared to the United States and to other places in the world. The challenges there can resonate throughout other economies.
Absolutely.
So with that being said, we talked about a lot of uncertainty. Obviously, there is uncertainty regarding the Fed, Brexit, and China trade deal, economic expansion, and earnings. I think there's more uncertainty, now than there's been in a long time. So, trying to make a prediction, is next to impossible. If in December, when it felt worse, you run out of the market, you made a big mistake. The big thing is to make sure you have the right allocation based upon your situation. But I just want to talk about life expectancy and retirement. This week, I met with a client who's 89, and a couple of weeks ago, I met it with a client. They're 90 and still dating. So with the longevity, your money has to last a very, very long time. So when I started in the business in 1982, during the Stone Age, back then, men were expected to live 73, 75, and a woman 75 to 78. Today, there's a 90% chance that if you're a couple, that one of you is going to live to 80, and a 50% chance you live to 90. I mean, we're seeing clients get hip and knee replacement in their 80s now. The bionic man was, it's happening today. You get hips, shoulders, knees, whatever you need. So it's important that you plan for a very, very long retirement, and that you have the right portfolio. To me, that's the biggest key, is having the right portfolio for your situation. And again, what you can do is you never want to have too much risk. If you have too much risk too much in equities, real estate, or concentration in equity or real estate, you really need to look at your long-term strategy, what your liquidity needs are. Anything that needs to be liquid for college payments or for buying a car should be in cash or short-term money instruments. And again, risk management, and that's what we're looking now as a team in portfolios and rebalancing opportunities as we did in May. So really, it's diversification, asset allocation at this point in time. At some point, somebody's going to be right about what happens and when it happens. But until that happens, nobody knows who's going to be right. So just keep that in mind when watching all the pundits on CNBC. And with that, I'll hand it back over to Cherie.
Thanks, Roy. Once again, thank you for joining us on this webcast, and we look forward to continuing our series of these calls with you in the future. And if you missed any part of this webcast, a replay will be available on our website shortly. We really do appreciate your feedback, so please feel free to send us an email with your comments to pwm@prestigewmg.com. That's pwm@prestigewmg.com. Have a great day.